Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me would typically be the mayor of Beckerville, USA, Mr. Michael Becker, but he is on another due diligence assignment. Boy, that guy is busy buying and selling large apartments throughout the state of Texas. So Old Capital has a bi-monthly educational event. We call it the Old Capital Speaker Series, where we bring in super interesting and dynamic speakers for investors to be educated. As you can imagine, at Old Capital, we work with lots of industry professionals that you want to listen to, chat with them, and really become educated on what is going on in multifamily. So at these Old Capital Speaker Series, we usually have 300 or 400 apartment investors at each meeting. Doesn't cost anything to attend. Investors, either general partners or limited partners, come to the Grapevine Convention Center near the DFW airport to understand what is going on. The meeting starts at about 6 p.m. and it starts with networking. So people come in, shake hands, talk with some old friends, get to know some new friends, and it's a great warm atmosphere to come in. We don't serve cocktails or drinks. We don't serve you water, but make sure you eat before you come over and see us. But it is very, very low key, very casual, and so then we have our speaker come up and chat, and they chat for usually 45 minutes to an hour, and they give you super updated information about what's going on, whether it's interest rates or the market itself, or anything that we think is important for you to really be in front of. So then the next thing I like is when we have the local brokers come up and they talk about really what's going on in the market. They talk about some of the new listings that they're coming out with, what the possible whisper price is, where the property is located at, what the backstory is. And then, they share all kinds of great information. So we have a number of brokerage companies come up and just chat with everybody in front of the room. And it gives people an idea of what the velocity of the transactions are out there. How many listings they have, how many deals under contract, is there hard money in these deals? So they share a lot of great data with you. So then, after people come and they'll probably stay there for another hour and a half of networking. So we spend a lot of time after the meeting just getting to know people a little bit better, just to understand what's going on. So everybody comes together and they, limited partners find general partners find limited partners. So it's a great networking opportunity that you go there for really two reasons. One is to get educated and get up to speed about what's going on. And then two, to get networked. So networking is huge. So we'd love to have you come out to the Old Capital Speaker Series. We've been doing it in Dallas for about 10 years. And if you're not going to a meeting like this in your town, maybe it's time for you to start one. Become the authority in the marketplace, bring in some great speakers that people can appreciate, and have it at the library or have it at the convention center like we've done for 10 years, so people know exactly where it's at, and then just be consistent with it. So it's a great education, great networking. So last week at the Old Capital Speaker Series, we brought in Greg Willett. So if you were there, you learned a ton of fantastic information about what's going on with rents and in pricing and what we can expect going on in the future. So Greg was the chief apartment economist for RealPage in Dallas for over a decade. And then just last year, he joined Marcus and Millichap on the institutional property advisor side. He's the guy you want to listen to. He is featured in financial newspapers and magazines. He's the guy that's being interviewed on radio or podcasts, because this is the guy. So bankers listen to him, apartment developers listen to him, and by God, I want you to listen to him. So he's very good. So we only recorded the audio. So I attached the slide deck from his presentation. Listen to Greg. He knows his stuff. And again, I want to thank Greg for coming out and all the good folks over at IPA that made him available on last week. So our next speaker series that you can join us is going to be on March 22nd with JP Conklin. You know JP because he's the interest rate guy at Pensford. We scheduled this meeting on the same day that the Fed meeting is going to be. And yes, that's March 22nd. So we will know if the Fed raises the rates again by 0.25% that we thought was going to come, and just get JP's opinion on what the future interest rates movements are going to be. So, but you need RSVP to this meeting. So go to the Old Capital Podcast website, oldcapitalpodcast.com, oldcapitalpodcast.com, to become part of our group, and you'll get educated, and then you'll be part of the networking that you want to become part of. So again, come to the Old Capital Speaker Series. If you're available in March, we'll have another one probably in April. So again, let's listen to this podcast with Greg Willett. Let me know your thoughts. Again, I'm Paul Peebles. Have a great day. Thank you, Greg.
Awesome. Thank you, Paul. I appreciate the opportunity to join you tonight. If you've seen me before, I tend to think of myself as more of a real estate guy than necessarily a wonky economist. But I think there's some interesting things happening in the economic world. So I'm going to be a little bit of an egghead in the first half of the conversation. But I'm good at reading the audience. So, if there are lots of yawns, we'll move on from that. So the game plan is, let's talk about some big picture things that are happening in the world. And then I want to talk about what is happening in the Dallas-Fort Worth apartment market and make some comparisons from DFW to other investment choices across the Sun Belt. And you can see that I have titled the presentation, A News Cycle Begins. And so we've had, as already been alluded to, a little bit of a struggle in the marketplace, a modest correction. So we're now starting to move into what's next. And that tends to be how I think about the world, particularly in investment strategies, not what's been successful over the last decade or so, but what does the next economic cycle look like, and what are the smart plays to make there? So let's begin. I'm going to give you 3 key things to watch for that in the big picture that I think will be happening over the course of the next year. And already alluded to tonight, it's all eyes on the Fed and what's going to happen with interest rates, and that has a huge impact on what's going to happen in the real estate markets in general, including what's going to happen in the apartment market. And is the Fed going to make moves that will actually push us into recession, or can they they talk about the soft landing where you manage to lower inflation without crashing the economy? Is that going to be possible? So let's talk a little bit about that and look at inflation numbers. So the primary number to look at is that black or dark blue line. You can see current inflation registers at 6.4% year over year. A new inflation report comes out tomorrow morning. So that number changes as of tomorrow. Hopefully it comes down a little bit more. And you can see we are slowing that inflation number, that we were at 9% whenever we hit the peak early last year. So we're moving in the right direction. And I think it continues to move in the right direction. And now let me get super wonky on this one. The biggest component of inflation is housing. And how is the price of housing moving? Well, you guys are already in the industry, and you know that rent growth has already begun to slow in a meaningful way. And that actually happened. The peak in rent growth registered early last year. So we've had almost a full year of rent growth beginning to slow. And that's true in for-sale home prices too, that the peak in growth was at the beginning of last year, and it's been slowing down as well. Now, the way that CPI, Consumer Price Index, is calculated, there's a big delay in those housing prices working their way into that calculation. And I won't go into technically why that is, but the slowdown in rent growth and home prices is actually just now beginning to show up in those overall inflation numbers. So again, that pretty much guarantees that inflation number is going to move in the right direction. And the folks at the Fed know that. So I think that's one of the reasons that Paul already alluded to. We think there's one more bump in interest rates, and that's really much the consensus view that in March that interest rates will be pushed up another 25 basis points. And then the world's kind of 50-50. Do we get another 25 basis points in May? But probably in May at the latest, the Fed pauses then to see what happens and make sure that things are moving in the direction that we want them to move in. So to the degree that the Fed is watching the inflation numbers, I feel good about we're moving in the right direction. To the degree that the Fed focuses on another number, I may be less confident. That other number is wage growth. And you can see that wage growth has slowed down a little bit from where it was at 5 to 6% when that peaked a few months ago. But wage growth currently 4% and change. Once that gets baked into the way businesses operate, it's kind of hard to pull back on that. And it's also, when you look at the current unemployment rate, which is 3.4%, is the lowest unemployment rate we've had in 50 plus years. So employers in most industries are struggling to hire right now. So that tends to push up wages as well. So it's hard. It's going to be hard to get that. We want that wage growth number to come down to, let's call it around 3%. We've made progress, but it's hard going from where we are now to get the rest of that cooling off. And obviously there are differences from industry to industry. Certainly grabbing the headlines now, tech is very much downsizing and struggling. We're having some layoffs. Housing and commercial real estate, most people I think would say we are actually already in recession in those segments of the economy. So the question is, does this spread to the economy overall? And do we go into recession to pull down that wage growth number? And I'll point out, this is actually not an unprecedented thing where the term that's being used now is rolling recession and kind of going from one industry to another. We actually had that in the late 1980s, and it looked like we were going to get away with no general recession. It was just going to be a spotty recession, but then the Gulf War happened and energy prices surged and the whole economy went into recession. So there is that question, can we avoid really widespread cutbacks? And I will share that our baseline number for this year, and I'll get to a slide that I think has this on it shortly, we're still calling for some employment growth in the U.S., but much, much slower than what it has been over the past couple of years. And whether or not that's technically a recession, I don't think it really matters, but the general expectation is a meaningful slowdown in growth. So, question number 2, big picture to look at. So, for those of you who are a little bit hands-on in operations, what happened in the last half of last year in terms of renter prospects coming in the door and the ability to lease units? The market just froze. And we had gotten off to a pretty good start in 2022, and then everything stopped. And I'll point out, it was not just the apartment sector. It was also, there was very little demand for single-family homes. There was a big slowdown in demand for rental single-family homes as well. And so we just stopped forming households in the last half of last year, which is maybe surprising given we were still doing pretty well in terms of job production, but inflation numbers, and I'll point out inflation numbers impact everybody. Job numbers, if there's weakness in the job market, that impacts a segment of the population, but everybody feels those inflation numbers. And at the same time, lots of talk of recession as a possibility. And so you're nervous, you don't know what's going to happen. What do? Typically, you do nothing and just freeze in place. And so that happened last year, but we think we're moving past that now. And to put some numbers to it, we've had this really weird renter demand pattern over the past couple of years. And so you can see in 2021, we had demand for about 700,000 apartment units across the country. And certainly that was the biggest demand number in the last 3 decades by a huge, huge margin. The previous high had been about 400,000 units. And then you can see from that 700,000 unit peak, boy, did it drop off. And so for calendar 2022, and also the number varies a little bit depending on what base source you use. We follow 2 different companies that put out these calculations. One of them has net demand slightly negative. The other one has net demand slightly positive, but the point is the same: drastic drop-off in people leasing apartments. As we go into this year, we think that demand number is going to be better. Even though we think the economy, job production is going to be slower, we think that demand number is going to be better. And a couple of things influence that. First, I'll point out, look at past periods when we've had negative. I mean, they're very short. And regardless of what's happened in the marketplace, people need a place to live. So it's never going to be actually negative for a long period of time as long as you've got some population growth. So we think that's going to help things. Again, to me, inflation had a bigger impact on these numbers than on demand numbers than the job production did. I've already said inflation is slowing down, and clearly as we go through the rest of the year, it's going to continue to slow down unless something really, really weird happens. So again, that we think that's positive. And then I'll throw one more indicator for you and look at the dark blue or black line, which is consumer sentiment. And so you can see consumer sentiment over toward the end of the chart here. It's low by historical standards, but look what has happened in the last few months. We're really starting to make some progress there, that people are feeling a little bit better about the world and a little bit more confident. And then I'll throw in one other thing to look at. Again, I came from technology world, and in technology world, you can very easily measure online searches for apartments. You can measure what's usually referred to as guest card creation. So that means someone reached out in some way to ask about renting an apartment. And so you have some sort of record of that's a prospect for you to follow up with. And then there's actual leasing activity. And it's 1 month, the month of January looked like normal January. All those indicators moved in the right direction after we had demand just completely disappear in the last half of 2022. So again, a good signal that we're going to get some renter demand back. And we're going to need renter demand because we are about to deliver a lot of additional apartments to the marketplace. So what you see here is a chart of the number of apartments that are physically under construction coming out of the ground right now. That is north of 900,000 units across the U.S., and you can see how much it has ramped up. Now, they will not all be delivering at once. If you talk to developers, when are you going to get finished? That would point to about, I think the number is about 550,000 units completing this calendar year. I think that number's high. In our actual models, what we have plugged in is about 400,000 units completing. There's a big difference there, but for the last few years, man, we have been building as fast as we can given the supply of labor that exists to build these apartments. And for 3 years, the number of completions has run right at 350,000 units a year. I don't know how you go from 350 to 500 plus when you have not, in fact, increased the labor pool in any significant way. So I feel very confident in saying we're not going to deliver 500,000 apartments this year, even though that's scheduled to happen. But we are going to go above what has been happening historically. So again, I said 400,000 deliveries. Let me back up. Demand for 200 and change. That means vacancy is going to increase and rent growth is going to slow down. Let's go to the other big thing to watch for, which is, let's begin with property performance fundamentals are probably going to converge across markets. If you go to 2021, when rent growth peaked, the range was about 25 percentage points. You had the best markets were getting rent growth of close to 30%. The struggling markets were at 4 to 5% rent growth. So that was 2021. Go to 2022, the range was about 15 percentage points. So beginning to slow down, but still pretty significant. We think that this year, the range is from the best performing markets getting 5 to 6% rent growth, the weakest performing metros getting basically 1 to 2% rent growth. So that's a much, much narrower range. And really the key factors that come into play, these markets that have been doing so well, that's where all this new supply is coming in. So that's really going to slow down the rent growth and create a competitive leasing environment in those markets. So let's talk a little bit about the markets that are at the top. Rent growth, our strongest market as we go into the coming year, we've got Miami in there. And every year we do an overall rating of markets that looks at rent growth and vacancy movement and general demand and economic momentum. South Florida is what we think will be the best performing apartment market in the country over the next couple of years. DFW is actually number 2. And you can see we still have DFW as for this year, a top 10 performer for rent growth. And then maybe the surprise is a bunch of the last half of the top 10 is heavy on Midwest markets, which are normally slow and steady and not necessarily impressive performances. But this is the one part of the country where you're not going to deliver a whole bunch of new supply over the next year or two. So that's going to give them some momentum there. So those are our general outlook across markets, but then I'll point out the second part of my statement here. And also I'll point out as we talk about markets converging in performance, we also think the difference between urban core and suburban will begin to converge as well, whereas we've been and had a couple of years where the suburbs meaningfully outperformed downtown markets. We think that those performances are going to, again, be pretty similar for the next couple of years, but results by property class are in fact going to break apart. And here, let's look at vacancy for the example. Current vacancy across the U.S. is right around the 5% mark. And you can see the difference between Class A, Class B, Class C. It's not really meaningful. But all this new product coming in, it's very focused on luxury product. You're clearly going to have rent concessions in these properties that are moving through lease up. That creates a challenging environment for existing Class A product. Hard to push rents when you've got brand new product, luxury product coming in across the street from you in most places. So we think there's going to be a big difference across product type, with Class B clearly being what's going to drive the rent growth and hang on to meaningful occupancy over the next couple of years, versus a much more challenging environment that we're going to see in top of the market communities. So from there, those are my big picture observations. So let's talk again a little bit about what we think will be happening in the DFW apartment market over the next few years, and how does that compare to some other places across the Sun Belt. Let's talk about the economy, which we are used to in DFW. I'm going to throw out a technical term. We're used to it being awesome in DFW. And you can, so what we're showing here is the number of jobs that are created since the beginning of the pandemic. So the comparison point is February 2020. And then we all across the country lost a bunch of jobs, and then we added a bunch of jobs back. Where are we overall? You can see the absolute change, DFW, 340,000 jobs ahead of where we were right before the pandemic hit. That's a huge number compared to what other markets have done. The best other ones, Atlanta, Houston, Austin, 120 to 140,000 jobs. And you can see for DFW then, that's total job growth of about 9% in that time period. The only market that has done better on a percentage change is, in fact, Austin, which is about 11% growth. So we have done a fantastic job of creating jobs in the DFW market. So that's today versus pre-pandemic. The other thing I'll point out here, look at this list here and how Sunbelt heavy it is, which is, I think, a big takeaway. So other than the Inland Empire in California, which is the Riverside, San Bernardino area, really it's all Sunbelt metros that have been growing. Where are we over just calendar 2022? What happened? DFW gained 235,000 jobs, 6% growth just over the past year, number one in absolute terms and number one in percentage growth. An impressive number. I will point out that over the past year, look at the mix of markets that are on the leaderboard. That's changed somewhat, that you're starting to see some comeback for New York and Los Angeles and Chicago and Seattle and Philadelphia and these gateway markets that were initially slow to get going, but have done well more recently. All right, so next up, what do we think happens this year? Again, our base scenario, significant slowdown for the U.S. overall. I'll point out 4.8 million jobs created in the U.S. last year. We think the number this year for the U.S., 700,000. So that's a pretty significant slowdown. DFW going from 200,000 to only 28,000 created this year. So again, meaningful slowdown. Is that right? Is that wrong? Very debatable. Economists are going to have different opinions. I'm just showing you that when we built our performance models, those are the numbers that are plugged in for the economy. So even at that, with drastic slowdown in the for DFW, it would still be we think it'll be the number 2 market for job production, with only New York doing better, but meaningful slowdown. Again, I think in terms of creating housing demand and including demand for apartments, what happens to the inflation number is more important than what happens to the job number for the moment. Obviously, over the big picture, the longer term, you want that job number to come back. All right, let's talk about a couple of other things that influence apartment demand, and one of them is in-migration. So just people moving from one part of the country to another. And here, the dark blue states are the places that did really well in terms of attracting newcomers. The medium blue had some growth, but not as strong. And then you can see there were some gray ones, California, New York, New Jersey, Louisiana, that actually had people on net left. So the pattern we've seen last year as well as the year before that, to me, 3 key pockets exist in the U.S. And so if your strategy is, I want to get in front of demand, and then we'll figure the rest of it out, then these are the places to be. Number 1 is Florida. Number 2 is Texas. And then number 3 may be a little bit under the radar just because it's split across multiple states. It's the Carolinas plus Tennessee have a lot of momentum. And I will have to say, big picture, some of my favorite markets are, in fact, in that Carolinas and Tennessee cluster. And then Georgia, primarily Atlanta, reasonably okay also, but not quite in the same league as the other spots. And then one more thing to talk about in terms of demand for apartments. It is really expensive to buy a house at this point, which is, for across the country, really encouraging people to stay renters. In DFW right now, if you bought the typically priced house, your monthly payment would be $1,800 more than if you paid the typical apartment rent. Obviously, that is a difference that we have never seen historically. And as much as we're pleased with apartment rent growth over the past couple years, realize that home prices went up much, much faster. And here you can see across the country, DFW home prices went up about 40% over the last couple of years. There are spots in Florida and Phoenix that were even much stronger than that. And then the other one that I would point out on this list, look how much more home price inflation you had in Austin than in DFW. And I'll point out, being at the top of this chart, that's not good. So, yes, your home value went up, but that feels like overheating correction could be on the way when you're at the top of that.
So
yes, sir.
Pre-pandemic, would that be 2 years?
So this was a calculation from fourth quarter 2019 to 2022, so 3 years. All right, so let's talk a little bit about what is happening with vacancy locally. And you can see in 2021 how super low we got in the apartment sector. That basically here and in most markets across the country, the vacancy rate was cut in half from what it normally is. And obviously that was that year where across the country we absorbed 700,000 apartment units. And that meant we just ran out of vacant units. We've started to move up now. We ended the year with vacancy in DFW at 5.9%. As we look at the deliveries coming in this year, we think we'll finish a little bit more than we'll be able to absorb. So our expectation is the vacancy rate this year is going to go up to about 6.5%. So certainly a higher vacancy rate than we have gotten used to of late. But if you look over the longer term, vacancy does tend to run a little bit higher in this market than in other parts of the country. And also, as we're doing our forecasting and thinking about what's going to happen, we let vacancy get a little bit higher in the Sunbelt markets relative to other places, and you still keep some rent growth versus there are other spots, particularly in these gateway markets, whenever you get a little bit of vacancy, and the operators freak out and start slashing rents. But we're comfortable with a little bit more vacancy here in DFW and across the Sunbelt than in most places. So again, that vacancy number is moving meaningfully to some degree, normalizing. And again, I promised you some cross-market comparisons. So these are the 10 biggest markets in the Sunbelt, and they're ranked by size. So DFW has the most apartment units, working down to Charlotte is number 10. And you can see in all of these, from the low point of vacancy, which was in most cases was either fourth quarter of 2019 or fourth quarter of 2021 or first quarter of 2022, vacancy has gone up about 300 basis points, the one exception being lesser increase in vacancy. Again, it's Miami, which in pretty much all of our metrics, Miami is going to be the best overall performer right now. Turning to rents, we're now up to typical rent in DFW is a hair under $1,600 per month. Over the course of the past year, an increase of about 10%. Peak growth was in 2021 when rents in DFW went up about 17%. So we are starting to slow that down. And again, I think I've already shown you on a previous chart that our expectation this year is about 4.5% rent growth, with most of that occurring in the Class B product. Did you want to jump in with a question? Price per square foot, I don't know. I would have to look that up.
175.
There we go. All right, so let's talk about, again, construction. What we like to build in Dallas-Fort Worth. There are currently 65,000 apartments under construction locally. That is, in terms of the absolute number, that is the most across the country by a huge, huge margin. But DFW is a big market. Inventory growth rate, that translates to about a 7% increase in the inventory. It's aggressive, but it's actually not as over the top as some other places in the Sun Belt. You can see Phoenix has about 12% inventory growth on the way. Austin, Charlotte are both right at 15%. I think next one on the list in terms of market size is probably Nashville. That one is also at 15% inventory growth. So a lot coming, but from our perspective, DFW not as over the top as some other Sunbelt locations in terms of building activity. And having said this, I'm also going to point out across the country and here locally, starts in 2023 become way, way, way down. And reflecting a couple of things. Number one, we just need to, in some cases, pause and digest some of this product that's already on the way. But if you're going to give developers money, they're going to build, but the financial sources are they're not eager to give out new construction money at this point. I was on a panel last week, and one of the other speakers is the local head of development for Trammell Crow Company. He said that their expected starts this year will be down 50% from where they were the last couple of years. As I talked to developers across the country, particularly the big guys who rely on the big banks for their source of financing, that 50% number is typically what you hear. If you look at more regional sort of builders who rely maybe on the regional banks or the local banks, they'll be a little bit more aggressive, but their number's probably going to come down at least 30% from where we were. So that means, but again, 900,000 plus units under construction now. 2023 and 2024, it's already banked in that we have huge completions. But by the time we get to 2025, that number should be coming down quite a bit. So, giving you some perspective, again, we think that while there are 65,000 units under construction in DFW right now, we think only about 25 to 30,000 of them actually complete this year. So the equation is not as lopsided as maybe the overall construction numbers would suggest. But again, that's still challenging. It's going to be hard to get those new deliveries through lease up, creating a competitive leasing environment. All right, so going into the home stretch, what we've seen here is we've certainly had a significant run up in apartment sales prices in DFW over the past few years. And if we look at calendar year as a whole, still some cap rate compression, but cap rates actually did move up late in the year relative to where we were at the beginning of the year. So still a fairly pricey market, although it's not up to the national average, versus there are other spots, including Sunbelt spots, most notably Austin, where pricing has actually moved above the U.S. average. And then here's an interesting analysis that we did, and looking at pricing growth since early 2017, looking at a handful of markets that were strategically picked because they do represent overall storylines. And I don't know why it's not showing up, but that gray line that ends up right under Denver, that's U.S. as a whole. So to me, where I would feel comfortable that you've not overheated and you don't necessarily worry about some price correction. It's that middle tier where you see Dallas, Fort Worth, and Miami, and Denver, and Los Angeles sort of approaches that level versus this chart says to me, you got some fundamental challenges in a San Francisco or a New York, and then you don't want to be Phoenix. I mean, that's a very, very aggressive run up in the pricing that makes you very vulnerable to some pullback. And I didn't put the other Texas markets on there, but Austin would be like halfway between the DFW number and the Phoenix number. So with that, let's talk about a handful of key things to take away here. Number one, and it's been mentioned, you guys mentioned it, I mentioned it, there's a disconnect between what's happening right now versus the big picture, longer game, which is the investment horizon for real estate. The Fed's going to do what the Fed's going to do. And that's going to actually have a meaningful impact on what happens as we move ahead. The Sunbelt metros, and especially Dallas-Fort Worth, as we look over time, are going to be the demand leaders. Again, I'll circle back to that strategy. Get in front of demand and figure the rest of it out. These markets are positioned very well, but they will have a lot of new supply coming in at the same time. And then final point, again, I'm not worried about we've gotten overheated in North Texas and that there's pricing correction in front of us, although pricing has pulled back a little bit from where it was at the peak. So those are some key thoughts from me. I'll do a little bit of self-promotion. There's my email address if you want to reach out to me. Julie, you mentioned LinkedIn. I'm pretty active on LinkedIn, put out a lot of content there. And you were also mentioning branding, Julie. I will take credit for, if you put information out on LinkedIn, you don't get a lot of views necessarily on Friday, so you don't want to waste your best content on Friday. So I started talking about small market on Fridays, and then it occurred to me at some point, just put a hashtag on it and call it Small Market Friday. And so now suddenly it's a thing, and people follow me for the Small Market Friday content and actually reach out and request small markets to be covered on Small Market Friday. And then one other thing I will point out, next week we're going to be doing a webcast that I think that will be interesting. We're calling it Capitalizing on the Next Multifamily Growth Cycle. I will point out that all of our speakers, which if you want to look at them, I mean, they're kind of heavy hitters, and these are companies who are not on the sidelines. They are already out there doing deals and building and trading product. And so I think it'll be interesting to hear their perspective on the marketplace at this point. The end.
Thank you, Greg. Is that good?
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.